So the main idea was that I was asked was to talk about a little about the business model for the accelerator. So what I thought that it was actually to look at it, not just go straight into that one, but it was to look a little more from the bigger picture. Why do we have different business models, and why we have metrics, and how do we align these things with the overall needs? So I'll try to go through that kind of approach and trying to connect those different points in a meaningful way. Then eventually we can discuss a little more what does it mean, especially what does it mean here for an environment like what is the current ecosystem for Tech Minsk and the Belarusian one. And I think maybe we can debate a little about what does it mean across time. So because environments are changing, so needs are changing. So from that point of view, even the models that you might want to use might be different across the time or in different setups. And actually I suggest that, well, we can do questions and answer at the end, but I think that we can, let's say it is a discussion so that we don't need to wait to the end and we can discuss a little bit together. So I think we can, hands up who doesn't know me. Damn, I wanted to skip the slides, okay. So actually I'll use this one. But basically I'm an Italian, I grew up in Italy, and actually I started my work activities in small, I would say family companies in the northern Milano area, and coding. I'm not sure how good it was as a coder, but at least was paying for studies and for traveling and for fun. And after that one, I decided that I didn't like the way they were doing the small Italian and family businesses. So like, how can we do it in a bigger way and growing? And there was nothing like TechMinks was other one. So I ended up working for General Electrics for 3 years in Italy and US, and to see a little on a bigger scale. And then as well, I did the same with Nokia, helping them to do projects in more than 10 countries, including some 5 years in Singapore. Then I jumped the ship before it started to sink when iOS and iPhone came out. And I ended up running an online community for Fox Mobile in Berlin. But actually that was my first going back to the origin small business, and actually was a startup doing 7 million people, 10 million US a year, 40% margins with 5 people running. So it was a small little thing. And then I started realizing, oh, cool, how you work corporate and startups. And I'm enjoying doing these things, and I'm enjoying helping to do changes and shapes and improve startups, not only in, do changes in big companies, but even in startups. And then after that one, I started to help startups via accelerators, incubators, and those other things. A little later, I was asked by Aalto University to shape a program for Microsoft and Nokia to develop Windows ecosystem on a worldwide scale. And so I did that one for a few years. And then I ended up doing my own company with other few co-founders, that is Vertical, and helping a few other startups, advising boards and so on. So I think we all know this one, but basically, like just to quote Steve Blank, but I think the main idea is that we know that especially when we work in this kind of environment, the startup is normally an idea or a little more than an idea, but they're still looking for the right product market fit and how to make it in a meaningful business way. So they are at the very, very early stages, not yet into the phase that when they want to scale and they need money just to scale, as in maybe big VCs or private equity can help. And so from that point of view, I think that the classic accelerators, incubators, and all the other derivatives or evolutions, they do focus on this first part of the life cycle, that is the search part. So I took Wikipedia. I think they are a little better one on the literature by researchers, and but I think that I like the idea to think that an accelerator, it's different than an incubator or other instruments, because you normally have a limited period of time with a cohort or a batch of startups where you apply pressure, competence, and mentoring, and a number of other, let's say, skills and competence in hope that you will deliver value to the startups in terms of evolving the way they operate and grow faster if they wouldn't join the accelerator. So that's the key thing. And the other key thing is actually so that's from the startup point of view. And from the organizer point of view, I think that the key element there is that actually cheaper, or let's say there's more economies of scales to do a batch of a number of startups rather than mentoring one by one on a normal basis, like mentoring and advising, like you do as a, let's say, an angel with hands-on approach. So those are the two main things. And the other key elements is the classic model, well, the one that was designed at the very beginning is that you take equity. Not all programs do that one, but I think if you look at the classic one, yeah, you do take equity and the payback will be on the increase of value of those that survive and prosper. So what are we thinking about, goals and KPI? I think that when designing or we're running an accelerator program, having clear what is the mandate, what are the goals of the program, is probably one of the most important things. I mean, why are you there to do it? And I've seen and I've been helping a number of different programs with very, very different goals. And you might have social responsibility goals, you might have ecosystem development goals for business reasons, or you might have a purely financial goals. And those are very different, and it might change actually across time. So I think that's number one that needs to be clarified and actually agreed by the relevant parties. And then I think you can then create KPIs according to that one, so that you start to, you agree, and then you start measuring across time the key performance indicator that it can help you to validate that you are delivering against your goals. So, and if I think about, the classic model again, the one we saw in the descriptions, you typically want to benefit, the organizers or the owners or the investors, they want to benefit from the success of the startup. That typically means increasing evaluation of the startup that then can be converted in, I would say, cash when selling equity of the company, either because there is an IPO or because there is a acquisition or a merge. So I think that from that point of view is then fundamental to understand that there are two major evaluation approaches or two major elements on changing the evaluation of the startup. One is the pure financial one. That is, when you are a more mature company, that is basically linked to how much revenue you have, how much profit you have versus the resources you have involved to deliver that one. And that's classic, and then anybody doing PE in the private equity world, that's the only thing that they look. But in reality, a lot of the startups are sold much, much earlier than that one. And they are sold not for the financial value that they have, but for the strategic value that they have. They might be much higher, or at least it could be the same value, but much earlier. And that's pretty good for investors. So from maximizing return on investment of a commercial accelerator, maximizing or accelerating the fastest possible exit, leveraging the strategic value is probably the more interesting thing to deliver to your investors. And then when thinking about how to run the program and what to focus on, that might be one of the key elements they want to look at least indirectly and pick sessions, pick activities that might help in that direction. So the commercial one, so that I give you money, I have a cohort of startups that we run. It's probably the most common one, but there are quite a lot, especially in the early phases of the ecosystem, that focus only on developing the ecosystem. So they don't look necessarily at the financial return. They look more at the social return in terms of the number of startups, the number of people employed, the revenue they generate, maybe eventually later on, the taxes that they can pay for. And if you're a corporate running an accelerator, I think they normally look more from the strategic value and the insight that they look at new trends and new opportunities. And so I think that the number of projects that they do, or the potential acquisitions that they have, or preventing others from doing might be more relevant one. And then the last one, I think that I'll explain a little later, but I've been involved in one case where there was actually, the accelerator was done to develop the ecosystem, but the ecosystem was being developed to compete against other ecosystems and to make it better and more compelling. And I think from that point of view, then what we were measuring was actually the number of developers that were involved and the number of apps and how well those were doing. So I'll start when looking a little more at the business model from the classic one. That is the one actually that basically created the whole industry and was developed by, I would say, fundamentally two key players. It was Wycom and 500 Startup. Basically, they created a new, I wouldn't call it industry, but a new phenomenon in the industry of the startup ecosystem. It was basically the accelerator. So they were the first one that discovered it. If I do a batch, it's more economical and efficient than doing one startup at any time. And then the model that they developed at the very beginning was the classic one used now, that I screen the startups, I give a little funding to all of those ones, I get in exchange a little equity. And my payback will then be in the long term on the exit value of those startups that survive and thrive, like we were discussing earlier. I would think that then lately we had other players like Techstar and Startup Bootcamp that are the one that I like the most, that actually they made a little evolution of the concept so that 500 Startup and Vicon, they are still the biggest one and probably never reachable by the others, but they are concentrated in one location in the world, so basically Silicon Valley, with different instruments on how they collect from other sides and channel all there. Versus Techstar and Startup Bootcamp, they adopted a model that they recycle the template in different locations again and again. So it's not related to a personality like Dave McClure, but it's more the process and the tools and methodology they developed and the content that they can recycle again. And the second element that they introduced was actually they can focus not only in different geographies, but even on different subjects. So it was actually Startup Bootcamp that started to focus on different industries. So they started to do one maybe on fintech, maybe on food, maybe on digital health, and so on. And now they have a whole range of categories. And that brought in the opportunity to work with corporates and other sponsors. So the second model that it was, or the second way of generating money for the accelerators, this was actually the one to work with sponsors. They've been doing deals with typically government that wanted to have the program in their own ecosystem to be able to bring the ecosystem to the next level, and have done it even with commercial companies like with other corporates. And I think probably the one that I admire the most, I must say, was actually Techstar when they announced that they've done an accelerator white label or semi-white label co-branded for Disney, and they were getting paid $3 million a year to run the program. And it's like, wow, if you think how much it costs to run it, that was actually quite a big price tag, but because they were leveraging their own network as an asset, and then as well as their own competence and brand. But I think the classic accelerators, so basically they run with their own money that they normally rise from LPs, and then they have a little announcement of additional money from sponsorship. That's the, I would say, classic model, the way I see it. Do you guys have any question? You all familiar with this? Disagree? Something to add? Okay, later? Okay. Then there's one thing that I was mentioning earlier that actually I was asked together with another co-founder to shape, develop, and run. And it was basically, was probably the first time we saw in the world an accelerator program that it was built to develop an ecosystem for a corporate. So basically, Microsoft and Nokia started to work together for Windows Phone, and they realized pretty quickly that actually nobody was giving, so to say, a shit about developing for Windows Phone. So there were very few apps, and they were actually, the average quality was pretty lousy. So Microsoft and Nokia, they adopted one approach that is a classic one, that had key accounts for all the big companies, like if you are Facebook, if you are Google, if you are whatever. And basically the account was developing the solutions or for the client, or helping them to develop it with a number of competence and skills. But then that was not covering the long tail. So what we did was to complement how you reach the long tail with a a program that was actually focusing on selecting potentially promising developers and entrepreneurs to and convince them to port or to create on Windows Phone. So basically, we were paying them. We were giving them grants from 10 to 70,000 euros to create or port on Windows Phone. And then we were helping them not only to create the app and tell them how do you do it specifically on Windows Phone, but we were even helping them to launch and to get tractions. So we could do global campaigns that was like maybe 100,000 downloads per week that we could influence on the good ones and coordinate with Microsoft Nokia and a few other parties. And this model basically, there was no LP. So Nokia and Microsoft were not doing this one trying to get a direct benefit. So we were not, unfortunately, taking equity, but we were basically, we got money from Nokia and Microsoft, and we're talking about 20 million for 4 years. And then it was basically marketing money, developers marketing money, that we then basically spent deploying for grants to the developers and entrepreneurs. So to make it very appealing and to shift the cost of porting to lower level for the Windows platform. So our return, there was no direct return financially. The return was indirectly because we helped to bring 450 developers on Windows platform and create top quality apps and generating 50 million downloads only in those 4 years. And that was basically benefiting indirectly Nokia and Microsoft in the number of devices they were selling and seeing them not lousy, but having a range of apps for the various cases. In this case, the business model basically for the accelerator was basically a cost structure. We were running it for the benefits of the community, and we did a number of activities to develop the community all over the world and make it cool. But we didn't get any revenue share, we didn't get any equity of the startup, so we didn't get any increase in value that we would benefit. And so I think it was just the KPI we were measuring. They were even financials, but the revenue of the startups, and no data benefits to us. The data benefit was on the client, that it was corporates and the two ones. Then I think this one is the classic, if I think about another case that I've been involved, that is actually Energy Spin, is the classic government or regional government accelerator that you probably have hundreds only around Europe and tens probably in each country nowadays. So what it basically means is that the region of Vaasa in Finland, they have a good big pool of companies working in the energy segment, because that's where the government concentrated all energy activities for the last 30, 40 years. Well, since the Second World War, when they moved the hub from close to the Russian border to the opposite side to try to make it more difficult to be attacked. And the goal here was basically to, social responsibility, to help develop the local ecosystem and to help create and make better a number of startups that they had in their ecosystem and attract from the surrounding areas to move there so that the ecosystem to grow. And what we were measuring there was basically the KPI we set up. They were a lot on the social responsibility. So we're looking at the number of startups attracted and eventually even better, the one that would settle and remain there. We were looking at the employment, so how many people were employed and how faster they were growing to employ, I would say, the developers, business development, and so on. And of course, we're looking at the revenue generation and how much that was growing during and after the program. And from that point of view, the business model here was reasonably simple. The government, the local government, was subsidizing, so it was a cost. But the program was totally tailored in a different way for the deliverables we wanted to achieve there. And they got a little of, they've been able to attract a little of corporate funding that was actually due to the corporates that were in that area that are working in this energy segment. because they wanted to be involved, and in a way they wanted to look good and see that they were helping to develop the ecosystem. And these classic accelerators, they normally don't take equity, so they don't have any significant upside. And the reason why they don't take equity is basically to keep it simple and to make it much leaner and to make it in a way more attractive for the startups that they saw a lower barrier to enter and less potential upside to give away to the accelerator. And then maybe an evolution of those ones we saw before is actually what I created with my co-founders 5 years ago almost. That basically is the company that I'm all in the board nowadays, so I handed over the role, the CEO role. But basically what we did was we realized that corporates are interested to develop the ecosystem, are interested to look at trends, and are interested in leveraging startups to acquire new products, technologies, and talent. So we basically set up a program that does tailored solutions or tailored programs for specific corporates. And we sit down with them, we agree what are the requirements, what are the issues that they want to address, and then we tailor the program, we screen for startups, and then we focus on the most difficult part, that is to shape projects and helping them to execute them, to deliver on those needs that they have, and ensure there is a commercial relationship between the corporate and startup in terms of project budget to do the MVP in these 3, 4, 6 months of the project. And then we help them to, if things go well, to develop a commercial relationship for the future. So that, it can be an acquisition, it can be a merge, it can be a limited investment, or it can just be a contract for delivering a service. And the business model in this case is that we are charging the corporate for the service provided. So every time is a different one. It's from 3 to 12 months. And it can be from tens of Ks to hundreds of Ks. And we normally don't take equity, but what we do is that we agree with the startup to be recognized a small revenue share for all the revenue that we help them to generate. So not for all the one they have, but only the one where we put cents and we help them. Because we have a number of companies in the same segments that we work with, corporates. So once we help the startup to succeed with one, we can then tap into the other, any other in our network to help them to do more revenues. And the other value for the startup is typically that we, especially if they are in the early phase, we help them to validate the offering with a real corporate, talking directly or co-developing together, and actually, getting paid to do that one. So I think that those are the key models that I see. And then if I translate what does it mean that one from the local environment perspective, I think that the Belarusian ecosystem, it's probably still, I would say a few years back, some other ones like in Germany or in UK or in Finland or in Sweden. So there's still need of players that initiate the ecosystem and grow it to the next level for a non-for-profit basis. And then little by little, I think that, I like what Tanya has been triggering now to start to do it on a commercial basis so that, you start to have LPs and then deploying capital to the startups in exchange of equity. And I think that's the right model. It's early, so it's still a lot of market making and a lot of cultural development, but then you might have the potential benefit of being the early mover and taking the key position in the market, because you typically cannot have multiple players. You don't have 3, 4 players, similar players in such a size of ecosystem. So normally the first mover is even the one that takes the biggest advantage and can protect themselves pretty well from other second movers, let's say, or third time movers. I think that's more of what I wanted to deliver. Any question, guys?
Yes. So let's talk about the last the last
This one.
vertical
Yeah.
VC. So you mentioned that they have some percentage of client revenue.
Yes.
And how many percentage approximately?
It's normally one digit, but it can go from 0.5 to 10%. Not much more than that one. I think it depends case by case. We look at what is the overall potential value of the deal, but then we look even at the stage of the startup. And how much is the impact that we make of it. If you're a startup at a very early stage and we help you to bring in a deal that is worth several millions, that probably is a big ticket. Versus if you're already a big company and quite established, and this is a small increment in your side, then you have less power to be able to ask for a bigger premium, and it comes more closely to what you would share into a B2B or B2B2C deal when you have a partner that sells in the channel. So you become a sales partner.
Yeah, and if we compare this business model with the business model of 500 startups, so can you?
Yeah, the first one. Yes, we can go back.
So this business model means that they have equity investments in startups.
Yes.
And again, how many percentage they usually have?
So the original started with very little money and the same terms for everybody. And the little money, I think that the very, very beginning, we were talking about 10, 20, 50K, or probably 10, 20, even down in Silicon Valley when they started 13, 14 years ago. In reality, now I think there are two major cases. And in two different geographical areas that makes a big difference. The first case is actually when you have one size fits all. So that basically, I have standard terms, take it or leave it. And cases like, for instance, Startup Bootcamp in Europe, you cannot negotiate. They have standard terms, standard evaluation. If you want to get in, it was classically $250,000 evaluation. If you don't like it, or if you got rounds already before, even higher, your call. And so there were a number of startups that were walking away from that one because they didn't like it, but there were others that were accepting, let's say, a down round because of the potential value that they would bring in terms of visibility, speeding up the development of the product, and the fundraising opportunities. The other model is the one that I think is more common, especially in the US, and it's basically where every case is negotiated. And that allows to deal with a broader range of maturity level. I mean, nobody that already have launched the product will go to an accelerator like Startup Bootcamp that you get $250,000 evaluation, because that would be too expensive for the existing investors. Versus with a model where you tailor the investment and evaluation to to each case, it gives you opportunity to work even cases that have actually much higher evaluation. And it's, of course, there is a side effect that you have much more admin work to do, because for Startup Bootcamp, you need to do two things. 3, the date, the name of the company, and sign. Versus if you can adjust the evaluation, you need to go through negotiations and then eventually, adjust the instrument accordingly. And especially if you're a little more mature, you got already other investors, already other preferential terms, so it becomes much more complex to set up. So those are the two things. The other element that I would say that is relevant looking is from geographical point of view. Evaluation in Europe are way, way lower than evaluation in US. So for the same cases, the money given out to startups in US, we are nowadays talking about hundreds of dollars or thousands of dollars, versus in Europe you talk about tens of thousands of dollars for joining an accelerator. And typically they give away, I don't know, I'm very familiar with Startup Bootcamp, they give away 8% of equity. Yep. That actually is divided between the local and the global team, but basically it's 8% to the program. Any other question? For
We're
free?
done with the presentations. Yeah.
Cool.
So we have 1 hour free. You can also join one-to-one meetings with startups, which are on the second floor. And we welcome everyone here in 1 hour in 5:30 to listen to startup pitches of Black Panda startups. Thank you.
Thank you very much.